Freeze the chart right here for a sec. Don't look at the spot price. Ignore the fiat noise. Focus on the candle itself. That massive, violent spike straight up isn't normal market action. It isn't organic stacking pressure. It's a signal that something snapped briefly inside the rigging. Silver didn't climb to 83 bucks. It teleported there in a flash, and markets only move like that when liquidity vanishes and the algos take over. 1 minute silver was trading under 80. The next it flashed over 83, and before the market could even breathe, they slammed it back down hard. A $9 swing in one session is enough to rattle even the grizzled stackers. If you're new, your first instinct is panic. You assume the squeeze just ended. You assume the bullion banks sold the top and left you holding the bag. That reaction is exactly what this tamp was engineered to create. Silverbacks see something very different. If you survived 1980 or the raids of 2011, you know this pattern instantly. This wasn't a collapse. It was a stop hunt. A deliberate, calculated raid executed in a thin holiday market when volume is low and the order book is fragile. Ghost week is when liquidity dries up, and when liquidity vanishes, price can be pushed anywhere for a brief moment. This wasn't about discovering a fair price. It was about flushing out the leverage. The machines forced price higher to lure in late apes, then ripped it lower to trigger forced selling. Fear was the weapon, volatility was the tool, and weak paper hands were the target. In this emergency update, we're going to expose what actually happened beneath that nasty candle. We'll show why the paper market acted like a rigged casino while the physical market barely reacted at all. The screen looked chaotic, but the real metal foundation didn't crack. This wasn't the end of the move, folks. It was the opening test. If you're still calm after hearing this, type 1 in the comments. If you want the full analysis, subscribe now because the next chapter explains exactly who got trapped, who stepped in to stack, and why this shakeout may have actually strengthened the trend. To understand why price slammed down so violently, you have to ask a simple question. Who was buying at $83? It wasn't the patient stackers, it wasn't the institutions, it wasn't the apes who accumulated silver quietly at 30, 40, or 50. The buyers at 83 were the late arrivals, the chasers, the traders who saw a vertical move on a Sunday night and convinced themselves that speed meant safety. Most of that hot money was leveraged, 10 times leverage, sometimes more. And leverage always leaves a fingerprint. When traders buy late with borrowed fiat, they protect themselves with stop-loss orders. These stops aren't hidden. They are mapped, clustered, and statistically predictable. The market knows where they are because human behavior never really changes. When silver pushed above 80, the majority of those stops sat just below 75. That zone was a magnet. Once spot began to roll over, the selling wasn't emotional at first. It was mechanical. Large blocks of paper futures hit the market at the highs, pushing price lower into thinner liquidity. As price slid through 79 and 78, nothing dramatic happened. But once it touched the stop zone, the cascade began. Thousands of automatic sell orders fired at the exact same time. Margin calls followed immediately. Positions were liquidated not by choice, but by force. That is why the drop felt like a waterfall. It wasn't sellers changing their mind, it was leverage being erased. The market was cleansing itself. And while that panic was unfolding on the screen, someone else was waiting. The same players who sold into the spike were already positioned to buy back lower. They did not chase strength, they harvested weakness. This is how leverage gets rinsed out of the system. It isn't fair, but it is how unstable markets reset before they move up again. What matters is what happened next. Price did not keep falling. It hit the mid-70s, and demand appeared immediately. That demand was real. It was decisive. It absorbed the forced selling and pushed spot back higher. That tells you the drop was not a rejection of silver. It was a transfer of ownership. The gamblers were finally removed. The market survived. Now look at the candle again, but this time through a technical lens. What printed on the chart is known as a shooting star, sometimes called a high-wave candle, a small body with a long upper wick. To most traders, that wick looks like failure. It looks like rejection. The market tried to go higher and got tamped back down hard. And in isolation, that interpretation makes sense, but context changes everything. A shooting star at the end of a long, exhausted trend is dangerous. A shooting star at the beginning of a breakout formed during a low-volume holiday vacuum tells a very different story. It signals excess speed, not structural weakness. The market moved too far too fast and needed to release some pressure. That wick is the release valve. Despite the violent drop from the highs, the close is the data point that matters. Ignore the spike, ignore the panic. Compare where we are now to where we were last week. Silver closed the previous week in the low 70s. After all the chaos, it is still trading near the high 70s. That is simply not failure. That is strength disguised as disorder. What you are likely to see next is not another vertical move. It is digestion. Price needs time to process a $9 range. Expect consolidation. Expect frustration. Silver may drift between 75 and 80 for several sessions, chopping back and forth in a way that destroys momentum traders and option buyers. This is not an accident. Sideways markets exist to exhaust your impatience. The key level has already revealed itself. The bounce occurred almost exactly where last week's breakout began. Old resistance turned into new support, and it held on the first test. That is textbook behavior. It confirms that real buyers are defending higher ground. This phase feels boring compared to the spike, but boredom is constructive. It allows moving averages to catch up. It allows volatility to compress. And compression, not excitement, is what fuels the next leg of expansion. The market isn't weak right now. It is simply catching its breath. While silver was thrashing violently, something else was quietly sending a message. Gold barely moved. It dipped slightly, held its ground, and remained anchored near all-time highs. That contrast really matters. In real breakdowns, correlations rise. Everything sells off together. That didn't happen here. Gold stayed calm, and calm assets do not coexist with broken systems. Gold is the anchor in the precious metals complex. When it holds, it tells you the monetary backdrop hasn't changed. Debt is still excessive. Confidence in fiat systems is still fragile. Nothing about today's action resolved those problems. Silver simply ran ahead of itself as it always does. It is the wild high beta sibling. It overshoots on the way up and overreacts on the way down. This is the cost of participation. Silver doesn't offer smooth trends, it offers acceleration. If you want the upside, you accept the turbulence. That turbulence is what taxes leverage and rewards true patience. Physical holders understood this immediately. They did not panic. They did not rush to sell. An ounce remained an ounce, regardless of what flashed on a screen for a few minutes. This brings us to the most important divergence of the day. While the paper price collapsed, the physical market did not follow. Dealers did not slash prices. Premiums did not vanish. In some cases, they even widened. That behavior tells you everything you need to know. Physical sellers were not convinced the move was real. When paper prices swing wildly, dealers protect inventory. They understand that the volatility is artificial and temporary. Selling physical metal into that chaos is a guaranteed way to lose fiat money, so they step back. Supply tightens. That creates a floor. This is why paper crashes do not always translate into real-world discounts. The drop existed on screens, not on the street. The disconnect is not a flaw. It is a signal. It tells you which market is unstable and which one is really grounded. Volatility shook the roof. The foundation remained totally intact. The next piece of this puzzle is volume, or more accurately, the lack of it. Ghost Week strips the market of depth. When traders step away for the holidays, the order book becomes hollow. Prices do not move smoothly in hollow markets. They fall through air pockets until they hit real demand. That is exactly what happened during the nasty drop. There were no buyers layered between the high 70s and the mid 70s. Price did not slide. It fell. And when it reached the breakout zone from the prior week, demand finally appeared. That reaction was immediate and aggressive. This was not retail buying. This was industrial and institutional interest stepping in right where it was always planned. Large industrial users do not chase price. They wait. When silver spiked above 80, it created anxiety, not enthusiasm for procurement desks. But when price snapped back into the mid-70s, it became an opportunity. Hedging programs activated, buy orders were executed, paper selling was absorbed and converted into real physical demand. That is why the bounce was so sharp. The market found its floor because that floor mattered. Old resistance at 75 became new support, and it was defended on the first test. This is not random behavior, it is purely structural. What you witnessed was a transfer. Speculative positions were forced out and stronger hands replaced them. This is how trends mature. Weak ownership is replaced by committed ownership. Each cycle raises the price floor. The result is a staircase pattern. Last month, the floor was near 65. This week, the floor appears closer to 75. Higher lows are not exciting in the moment, but they are the architecture of sustained moves. The paper tamp was noisy. The signal was quiet, and that signal says the physical bid is real. Now we need to talk about the volatility tax, because volatility is never random punishment. It is a fee charged specifically to leverage. If you were trading futures options or margin during this move, you paid that fee in real time. Stops were hit automatically. Margin calls arrived without warning. Positions were liquidated not because the thesis was wrong, but because the structure was fragile. That pain was engineered. It is how the market enforces discipline. Real stackers lost nothing. We didn't need to sell. We didn't need to flinch. An ounce is still an ounce. What we got was proof. For a second, the rigged game slipped up. That spike past 80 wasn't a glitch, it was a teaser. It showed exactly where the silver price goes when the paper shorts lose their grip even for a minute. This was also a stress test of conviction. When price exploded higher, it did so with ease. When it fell, it required force size and coordination. That asymmetry matters. It tells you where resistance truly lies. Energy builds in the direction that requires the least effort. Meanwhile, the paper bets got wiped out. The rocket was too heavy with weak paper hands. The ship tilted and the fake leverage was tossed over the side. Now the ship is steady again. Clean decks invite much stronger capital. This reset is constructive. If silver had marched straight toward triple digits without interruption, the eventual correction would have been violent and destructive. By flushing leverage early, the market reduced systemic risk and extended the life of the trend. Volatility feels like chaos in the moment, but in trending markets, it is maintenance. It tightens weak bolts, removes excess pressure, and prepares the structure for heavier loads ahead. The move looked brutal. The adjustment was necessary. Now pull your attention back and look at the bigger signal the market just sent. This move did not come from the outside. There was no interest rate shock, no currency collapse, no geopolitical headline that rewrote the rules overnight. The dollar stayed relatively calm. Bonds did not implode. Equity markets did not signal systemic fear. That tells us something critical. This was not a macro event. This was a structural purge. When markets break because fundamentals change, they stay broken. When they break because positioning becomes unstable, they rebound quickly. What you witnessed was a failure caused by excess weight, not a loss of belief. The longs were not wrong. They were simply overextended. The market did what it always does in that situation. It forced them out. This is why the launch pad for January looks much better after a tamp like this. The margin bets are gone, the paper interest dropped, weak hands are out, the runway is clear. Big money doesn't want to buy the peak of a frenzy. They buy the strength after the smash. A floor near 75 looks way more juicy than a vertical moonshot past 80 that hasn't been tested yet. Big money waits for confirmation. Violent shakeouts provide that confirmation. They prove that price can absorb pressure and still hold elevated ground. That resilience is the signal long-term capital responds to. Pay attention to the psychology shift. Just days ago, silver at 65 felt expensive. Today, silver near 78 feels frustrating. That reversal in perception is how bull markets mature. Expectations outrun price, and that creates fuel. This was not a warning shot. It was a cleansing. And markets that have been cleansed tend to move with far more force in the direction that remains. Now we need to confront the part of this chart that scares the tourist, that nasty long upper wick. It looks ugly. It feels like a smackdown, like the cartel slammed the door at 83 and manipulated the metal down instantly. Regular chart guys call this resistance, and for now, that is right. The market remembers that slam, and that pain creates paper sellers. Traders who bought near the top and survived the drop are now emotionally trapped. When price approaches that level again, many of them will sell just to escape at break-even. That selling pressure does not disappear overnight. It has to be absorbed. This is why 83 will not fall easily on the next attempt. The market needs time to process what happened. Expect a grind, not fireworks. Expect silver to move sideways between 75 and 80, churning in a way that feels pointless and exhausting. This phase is designed to break patience, not portfolios. Moving averages need time to rise. Volatility needs time to contract. Energy needs time to rebuild beneath the surface. This is the hardest mental game in a massive silver squeeze. The hype dies down, the news shuts up, and the FUD creeps back in. Many apes fold here, thinking the stacking is over. History proves them wrong, though. Real rallies need to breathe a bit before they blast off again. The wick did not kill the move. It mapped the battlefield. It showed exactly where sellers appeared and exactly where buyers defended. That information reduces uncertainty, and reduced uncertainty leads to faster future moves. Most importantly, the lows held. Buyers protected higher ground. Conviction did not break. The next breakout will not be loud. It will come when boredom replaces fear and when attention disappears. That is when the shiny price rips. Now let's bring time back into the equation, because timing is everything at this stage of a trend. We are approaching a critical window, the end of the month and the end of the year. These closes matter far more than any intraday spike or collapse. Daily candles scare people. Monthly candles move institutions. If silver holds above 75 into the monthly close, it will register the highest monthly closing price in history. Read that again slowly. Even with all the chaos, even with a $9 intraday collapse, the market is still on track to print a historic signal. That single data point outweighs every emotional reaction from today. Large funds do not care about wicks. They care about closes. They care about trends that survive stress. A strong monthly close tells pension funds, endowments, and asset allocators that silver is no longer a speculative sideshow. It becomes a legitimate allocation. That is when real size enters the market. This is also why the violence likely happened now, and not later. If leverage had not been flushed before year-end, it would have created instability during January inflows. The market preemptively cleaned itself. That makes the runway safer for larger capital to land. Get the mindset right. Closing near 78 feels bad because you saw 83. But zoom out a month. Not long ago, 78 sounded like a total dream. This shift in what we expect is how the stack grows value quietly, not with a loud bang. The battle into the close is simple. Bulls defend 75. Bears try to break it. As long as price holds above that level, the breakout remains intact, regardless of how ugly the path looks. This is not about predicting the next dollar. It is about respecting the signal the market is preparing to print. And that signal, if it holds, changes the game going forward. We have reached the final stage, and this is where mindset matters way more than guessing. Today was not easy, but the silver squeeze isn't built on ease. It is built on diamond hands. If you sat through a $9 tamp without dumping your stack, you passed the first major test of this super cycle. The final verdict on that shooting star candle is simple. Context decides meaning. In exhausted markets, it marks a top. In newly awakened markets, especially during thin holiday liquidity, it marks a reset. What we witnessed was not a reversal. It was a liquidity test. The market tested 83 and found sellers. It tested the mid-70s and found aggressive buyers. Now it knows the range, and knowing the range is how trends mature. Here is the strategic takeaway. First, audit your exposure. If today made you physically uncomfortable, you were carrying too much leverage. Reduce risk where necessary so volatility cannot force your hand. Strong positions are positions you can hold through noise. Second, respect the 75 level. That is the line that defines the breakout. As long as it holds, the larger trend remains intact. Third, stop staring at intraday candles. The next few sessions may be dull, choppy, and frustrating. That is not danger. That is preparation. The real opportunity lies ahead. January brings fresh capital, rebalanced portfolios, and institutions that care about monthly and yearly signals, not emotional spikes. The market just removed weak ownership and raised the floor. That combination is powerful. Mark my words, the biggest wealth transfers feel the scariest at the start. You aren't late. You are early in a market shifting from ignored to essential. Today's wild tamp down was just the ticket cost for the ride upward. If this analysis helped you stay grounded, make sure you subscribe, like, and share this video so more people can see through the noise. And tell me in the comments how you handled today's move. Staying calm is not easy, but it is how capital is built. The paper smash failed, the stack remains, and the next leg of this massive squeeze is just heating up.